Leverage is a great benefit for investors in closed-end funds in that closed-end funds have the opportunity to borrow at very low short-term interest rates and redeploy those proceeds in longer dated, higher yielding investments. The difference between the rates at which the closed-end funds borrow and what the closed-end funds are earning in the investment serves to increase what distributions would otherwise be for common shareholders. It's a great income boost. Despite the risks, it's a helpful benefit for investors in closed-end funds. Once an investor determines what allocation they have in their portfolio, they need to be mindful of what they consider the outlook for the asset class and realize that leverage magnifies the returns up or down of that underlying asset class. So the amount of the leverage and the rates at which the fund is borrowing are important considerations. Nuveen manages approximately $160 billion in municipal assets. Of the $60 billion in closed-end assets Nuveen manages, about 2/3 of those are in municipal bonds. We look at the closed-end structure as having two key elements for munis. Number one, the portfolios can be fully invested at all times, so because it's a closed-end fund, there's no need to maintain a cash position on an ongoing basis. And further, with respect to municipal bonds, those tend to not be as liquid as other types of securities, so it's very well suited for a closed-end fund in which the portfolio manager can invest in more illiquid assets. Once an advisor determines an overall asset allocation for investors, we consider closed-end funds a great tool within those allocations. Closed-end funds are available through a host of different asset classes, municipals, corporate bonds, floating rate products, preferreds, real estate. There's a closed-end fund for any given asset class that's available. Once an investor determines what the overall asset allocation should be, we think it's very helpful to include a small sleeve of closed-end funds within each of those sectors. It does a couple things. Number one, it increases what the income would otherwise be, but it also does it at a slight cost of risk, and we consider the increase in income more than offsets the slight increase in risk of the closed-end allocation.